please continue eating. You can certainly do that. I am Yut-Sung Chang. I'm Executive Managing Director and Head of the region for Asia Pacific and Standard & Poor's Rating Services, and I'm based in Tokyo. I am delighted on behalf of Standard & Poor's to welcome you to this event. I thank you for coming to this event. I appreciate that there's a huge crowd, but at the same time, apologies to some of you who are sitting on the side at the back as well, without food, and also apologies to those people who wanted to come to this event but were not able to make it. We will definitely work with the ADB next year to make sure that we can fill in a bigger crowd. As Suri mentioned, we have been sponsoring a seminar at the ADB event as an official program for the past 13 years. It is our honor to continue to do so. We find it very important, and we are very proud about it. It is an important priority for us in a sense that it gives us an opportunity to share our insights with regards to credit risks, market trends, and it would be a great thing for us to actually facilitate a discussion about a very important topic today. The ratings that we provide, the research that we provide, those support the growth of the transparent and liquid debt market. And that is very important in Asia Pacific, where the debt markets in Asia Pacific still are in a development stage, and some are only just beginning to develop. We would like to be a part of that development, and we are very proud to have a 40-year history and a very deep commitment in the Asia Pacific region. Today, Standard & Poor's has the largest network of any rating agency in the region, with on-the-ground operations, as well as many partnerships that we have with leading local rating agencies around the Asia Pacific. Today's seminar topic is Europe's sovereign debt crisis, a boon or bane for Asia Pacific's banks. And it's a very timely topic, we believe, and given what's going on in Europe, also with regards to all the concerns that people here in Asia Pacific may have as to what are the spillover effects of what's happening in Europe, and we would like to cover that today. At the same time, I would also like to mention that the Standard & Poor's Financial Services Group just issued a report called Why Eurozone Risk Could Still Hit the Asia Pacific Banking Sector in 2012. In your package, this report should be there. If you have time, please review that after the seminar. But I'm also glad to say that one of the co-authors, Ritesh Maheshwari, will be with us on the panel, and he will be talking about S&P views about the Eurozone crisis as well. As we all know, Asia is not immune to the issues that we see in the Eurozone. And with the outlook for the European economies and the global financial markets still uncertain, market participants in Asia Pacific are still figuring out whether the region, including the banking systems, can withstand the current pressures. And also at the same time, we're also concerning, is this really the time where we turn the tables around and make challenges and turning into opportunities? And can the Asian banks actually do that? And that's something that we would like to discuss today as well. So today's seminar will begin with opening remarks from our president, Douglas Peterson, and we'll follow it up with a panel discussion. So let me first introduce our keynote speaker, Douglas Peterson, president of Standard & Poor's. Doug joined Standard & Poor's in September 2011 from Citibank. He was the chief operating officer of Citibank's principal banking entity that operates in more than 100 countries. Until 2010, Doug was the CEO of Citigroup Japan, where he oversaw the entire Citigroup franchise in Japan. In prior roles, he served as country manager in Costa Rica and Uruguay. He was also a corporate banker in Argentina and New York. Where at S&P, we're very, very happy to have him as our leader. And I am very proud to be able to showcase Doug as our first keynote speaker. So Doug, and I would like to hand over the podium to you. Thank you.
Good afternoon. Thank you, Yut-Sung, and thank you all of all of us for joining us this afternoon. And as Yu-Tsung just said, it sounds like I've been in a lot of crises in my career. I started my banking career in Argentina, and it was during a banking crisis, and I worked closely over the years with Bill Rhodes and have had a lot of exposure, unfortunately, to financial crisis. I was asked to speak for about 15 minutes, not 2 hours. I could go on for 2 hours and give you a long discussion about what is happening in Europe, but we will take advantage of having a very well-informed group of panelists here to talk to us. I've been with S&P now for about 7 months, and when I travel around the world, the first question I get asked everywhere I go is, what is happening in Europe? And what is the impact on the European crisis to the rest of the world? So it's refreshing to be in Asia, where some of the meetings I've had today, people talk about growth ranges of 5% to 8% in different countries. Some people are disappointed that growth is decelerating from 8.2 to 8.1% or from 5.5 to 5.3%. But there's another part of the world in Europe where there is very low and very slow growth, and I will talk a little bit more about that. I'm going to talk this morning, or this afternoon, a little bit about some themes that are important for the global financial markets. And these themes of globality and the globality of capital flows, of trade flows, of goods and services, of information, and of talent. I will talk a little bit about the financial sector and the financial services sector. And I will talk about risk and the regulatory environment, and then we will have our panel discussion. Without a doubt, the economic situation that we're confronting right now is one that is very worrisome. It's one we need to pay attention to, and there are very important questions about the impact and lasting impact of the Eurozone crisis on Asia. And it's a good topic to look at today. We've been in a recession and changes in the financial services industry since 2007 and 2008. And the crisis has had different phases. And in many ways, there are countries in Asia that were much less impacted from the financial crisis, and the banking sector much less impacted than what we see today happening in the US and in Asia and in Europe. There's an overhang of debt and deleveraging that remains to be handled, which is very important for understanding capital flows and information flows around the world. But let me talk a little bit about what is happening in the US and the role that we're seeing of central bankers play to ensure that there's adequate liquidity and structural liquidity in financial markets. As you know, in the US, the Federal Reserve has completed 2 rounds of what is called the quantitative easing. There were the 2 rounds of QE1 and QE2, and there's a 3rd round now going on, which is called Operation Twist. The first rounds of QE1 and QE2 were over $2.3 trillion of liquidity pumped into the financial system through the purchase of assets on the balance sheet of the Federal Reserve. The new Operation Twist, which is approximately $400 billion of bond buying in a stimulus program and also geared towards interest rates, is scheduled to go through June. At the same time in Europe, we have the LTRO, the long-term refinancing operation, which is like a very large pumping of liquidity in the banking system through a repo program, is over 1 trillion euros, or $1.3 billion. So we've seen an incredible, massive amount of liquidity pumped into the financial system to stabilize liquidity and stabilize, in the case of the US, also the capital position of the banks. The Standard & Poor's economists predict that as we end up going through this crisis, we could see a 2-speed world. The fast, high-growth regions where you have young populations and commodity-rich and resource-rich nations, and then the developed markets going into a much slower growth pattern as they face their financial crisis as well as other impacts of aging and pensions and healthcare. Europe's lengthy debt crisis remains a very critical issue. our baseline scenario for Europe shows growth across the entire region of not much more than about 1% for 2013. We're still looking at growth for the entire Euro region this year being not much more than flat, or 0%, if you take into account the regional differences between Northern European countries that will be growing at 1.5% and those that are declining or decreasing at 1 to 2.5%. But for the entire region, we expect a flat GDP growth in 2012. For the U.S., the recent economic data is more encouraging and it's more positive, but it's much lower than what we've seen in prior recoveries from recessions. In the U.S., we expect that real GDP will rise 2.1% in 2012, and that is much lower, as I mentioned, than prior recoveries from recessions in the U.S., which have normally been at 3 to 5% growth rates after such a deep recession. In the U.S., we do see very different regional economies, whereas the economy in the center of the U.S. that's based on energy and commodities is much lower levels of unemployment, much higher growth levels. Other areas in Northern California where you have a lot of innovation and investment going on in technology, very low unemployment, very high growth, very high income, as opposed to other areas in the Great Lakes District, which went through a large restructuring of its manufacturing base, or the area around Southern California into Nevada, where you have a large overhang of a housing market. So the U.S. economy, with its growth rate, is actually a stabilizing factor, but across the U.S. economy, there's very different pockets of economic growth. Even as we're here in Asia, and I mentioned it's encouraging to be in a region where the growth rates are discussed in the 5, 6, 7, 8% range. Those are slowing down, and we're seeing impact from what is the demands coming out of Europe for Asian products. And even in China, we've seen a slower growth rate down to the 8.1% expected for the rest of this year. One of the long-term challenges that the economies face around the world, and I mentioned briefly, relates to the aging population and the demographics. It's one of the most important themes that we have to look at in an area like European zone. We're looking at a banking crisis, but we're also facing a demographic crisis in many parts of Europe if we don't also take a careful look at the growth of the aging population. We are just about to publish a report on the demographics and aging population, and S&P expects that there will be over 16% of the population in the next 30 years will be over 65 years old, as opposed to 7.6% today. And this goes along with healthcare costs. That's another very important issue to be addressed, as I said, in particular in the developed economies. And it's an opportunity in developing economies to get ahead of that trend and not wait until it's too late to think about social protection systems, healthcare, and pensions. Now, as I mentioned, when I travel, people also ask questions about the banking environment. The second question I get after asking about the Eurozone is what's happening in the banking environment globally? And within that context, the IMF has recently projected that the Eurozone banks themselves will have to delever by over $2.6 trillion over the next 3 years as they shrink their balance sheets and get involved with new changes through the Basel III and capital rules, and also some of the applications if they're have U.S. operations as well through Dodd-Frank. At the same time, investor sentiment has looked at the markets, and this deleveraging, which is starting to take place in Europe, is something that we saw in the first quarter. During the first quarter, the balance sheets of the banks, as they shrunk, was taken up by corporates in Europe that had to go to the markets to raise capital. There was almost a 50% increase quarter on quarter of European corporates going to the capital markets to raise financing as opposed to going to the banks. So these trends are something that we will see over time, which is the deleveraging of the banking market, the growth of the capital markets to pick that up. But this is a very large need. We estimate that over the next 4 years, until the end of 2016, that there is a requirement for $40 trillion of corporate refinancing or corporate new debt. That includes about $30 trillion of refinancing that will be required either through the bank or the capital markets, and $10 trillion of growth capital which is going to be required. Just to put that in context, today at S&P we have approximately 1 million ratings outstanding on $30 trillion of debt. So it's as if over the next 3.5 years we're going to have to see the entire amount of outstanding debt that we're rating today be placed into the markets. And part of that is going to be very important in Asia. Of this refinancing need and the new financing need, approximately 12 to 13 billion of that is in Asia, and that's in China and Japan alone. These are going to be very, very large numbers. As we look around the globe and we look at these trends and patterns, and we've been talking about the Eurozone and the banking crisis and what we see as the deleveraging needs, we also look and see what are the requirements for developing economies to invest in infrastructure. Today, here, I've had meetings with countries from the region that are talking about their opportunities, and the opportunities in order to become more integrated in the global economy, to bring more opportunities for their populations, require more and more investment in roads, in energy transmission, in ports, in airports, in water and sanitation. And this will be one of the opportunities for the Asian markets to develop local capital markets and local banking markets, where you take advantage of what some people call the demographic dividend and invest early in pension systems and saving systems to be able to finance that long-term need for infrastructure. This is something that will be very important for the banks to look at, and it also is incredibly important that we develop these deeper local markets. And it's one of the best opportunities for Asia, and it's one of those opportunities in particular for this gathering for people to not just worry about what's happening in the Eurozone, but also take advantage of being in an area that has so much to offer and such a large opportunity facing it. According to the ADB itself in the Asia Bond Monitor, in data released last week, between Korea, Indonesia, Malaysia, Philippines, Singapore, China, Hong Kong, Thailand, and Vietnam, there is $5.7 trillion of corporate debt outstanding, and that is expected to continue to grow and continue to be an opportunity for the financial sector, but in particular as it's used to finance growth and investment. The bond markets continue to grow, and they continue to be an opportunity in this region. And we also expect that Asian companies, as they become more global, will have more opportunities to tap the markets as well in Europe and the US. But right now, as we're talking about today, what is the environment of the Eurozone? And we're going to be having a panel here, and what will be the impact? One of the third discussion topics that comes up when I travel after talking about Europe and talking about the banking sector is what is happening in the regulatory environment, and what are some of the risks taking place in the regulatory environment. There's many bankers in this room, and I know that the bankers in this room would be looking at ways to ensure that we foment and value global capital flows, global trade flows, global banking environment. But we're in an environment right now where it's quite critical that the regulators also look at the harmonization of different aspects of capital, liquidity, and other flows. This is something that is one of the most important discussion topics when I attend meetings in Washington or Europe. And there is a need to come up with a framework to understand what will be the unintended consequences or the consequences of the regulatory environment, in particular to ensure that we do remain with open markets and open capital flows. And this is something that I think Asia should be part of that dialogue. It seems as if right now the discussion about harmonization is important. It's important that Asia have a role at that table. And especially when some of the unintended consequences of measures coming up are what people would say are potentially protectionist or potentially have extraterritorial impact that need to be considered. The Volcker Rule is one which is being debated openly right now, and very important that Asia have a view and remain part of the global dialogue. I look forward to having an open and lively dialogue with our panelists here this afternoon. I appreciate that all of you have come to listen to us and listen to our panelists. Since I've joined Standard & Poor's, I've had an opportunity to travel around the world and to go to different markets. There is a globality which has taken place the last 15 years that's not going to go backwards. It will continue forward. It's important that in these types of meetings we have a dialogue and we listen and learn from each other so that we can continue to promote growth and investment. The Standard & Poor's has a history in Asia that goes back over 30 years. It's a rating agency that is very well positioned in this market, very well positioned with our talent and our people to be part of the markets. And as I said, the markets will continue to be much more important as we do see the trends like deleveraging and the needs for infrastructure investment, for investing for the future from the demographic trends, that the capital markets will continue to be more and more important than ever. We have here a position in our Standard & Poor's ratings. We include a scale called the ASEAN scale, which is an important way for us to play in the local markets. I know that we've also given you some reports here today, which I hope that you have a chance to look at. But I'm very excited to be here, and as I said, it's great to be in a meeting where we can talk about real growth, about the population, the dynamism of this region. It's great to also be in a conference in a region where people are looking outward and not just looking inward, as we see in many other parts of the world right now. I want to thank my colleagues for organizing this conference. In advance, I'd like to thank our panelists for taking time out of this schedule to be here. And thank you again for being with us, and we look forward to having our dialogue and also including you in that. Thank you very much.
And I am very pleased and honored to have a very distinguished group of panelists, and their perspectives from diverse backgrounds, no doubt will be a very big asset to providing a very rich and robust discussion today. Let me introduce the panelists. I would like to start with my left, Gerard Lyons. Gerard is a chief economist and group head of global research at Standard Chartered Bank. He's based in London, and Gerard has held senior roles at leading international financial firms, and he is widely credited with accurate predictions ahead of the financial crisis. To his left is Henny Sender. Henny is the chief correspondent for international finance at the Financial Times. Before joining the FT in 2007, Henny worked for the Wall Street Journal, where she was the senior special writer for the money and investing section. And then we have Doug. Next to Doug is Lito Camacho. He is the managing director and vice chairman of Credit Suisse Asia Pacific. He brings unique perspectives from a universal bank that is strong in investment banking and wealth management, as well as his prior experience as the Secretary of Finance at the Philippines. And I guess one more information about Lito is that he was also one of our panelists last year when we hosted our seminar at ADB. Since he was so good, we begged him to actually attend once again, and I'm very glad he has accepted this offer. Next to him is Gilles Plante. He is ANZ Bank CEO for Asia and chairman of ANZ China. He joined ANZ in 1997 after 10 years in the wholesale banking industry, spanning various roles in Paris, Tokyo, New York, and Singapore. And then lastly, my colleague, Ritesh Maheshwari, is a managing director and lead analytical manager for Standard & Poor's Financial Services Group. Ritesh is based in Singapore, and he has extensive background in the analytics of insurance companies and financial institutions. So let us start the panel discussion. So I would like to start the panel discussion first by putting the current situation in Europe in context and probably setting a stage about what's going on in Europe and what's the deleveraging process that is going on right now. And the best person, I think, to start really is to have Gerard talk a little bit about certain things. He is the economist of in this panel, and he resides, in Europe, and he lives and breathes, the issues that we are seeing in Europe on a basically daily basis. So Gerard, I would like to ask you, you're definitely the best person to talk about this. What are you seeing? What is going on in Europe? And what are the consequences of the deleveraging process that's going on in Europe, the impact on Asia, maybe even the world, in terms of economic growth, in terms of the flow of funds, and even the impact on investor confidence?
Well, thanks for the question. It's a great honor, great pleasure to be on this panel. In terms of Europe, I think it's important to put it in the global context. So maybe the global, then Europe, then the implications for Asia. I think we live in a very divided and very disconnected world economy, which is leading to major policy dilemmas. The divisions are very apparent, East versus West, a resilient East, a very fragile West. It's a very apparent also within Europe, where the core of Europe is in apparent good shape, the periphery of Europe in deep trouble. And it's a very disconnected world economy where the Arab Spring has become the Arab winter, and there's high rates of youth unemployment across the globe, but particularly within Europe. And as a result, in this policy environment, not only do policymakers have to contend with trying to ensure recovery, trying to address the financial problems in the West, but politicians in particular are playing to the gallery. They want to be re-elected. They're not addressing longer-term problems. They're only looking at short-term solutions. So this is a very difficult backdrop. And it's against this backdrop that the problems in Europe are particularly acute. And I don't think anyone in the room should underestimate in any way, shape or form the challenges facing Europe and the contagion issues, therefore, that could impact Asia. In a nutshell, the euro is fundamentally flawed. Simple as that. And therefore, a fundamentally flawed euro requires a fundamental longer-term solution. The European Central Bank did pull us back from the brink, both in December and in February, and that largely helps explain why financial markets went from the extreme of pessimism last autumn to optimism in the first quarter. Last autumn, the markets were fearing a hard landing in China, a double-dip recession in America, and a near collapse of the Eurozone. Of course, the data in China and in America turned out better than the markets expected. But the key thing that helped change sentiment was the actions of the European Central Bank. And the ECB did do the right thing. They bought us time. But as we've moved into the second quarter, markets are now coming to a greater sense of reality. And the challenges in Europe are this, that basically one size does not fit all. In the good times, the euro encouraged money to go from the core to the periphery. Spain and Ireland had better fiscal positions than Germany 4 years ago. This is not a debt problem. This is a lack of growth problem, I would argue. In the bad times, just as the money went from the core to the periphery in the good times, in the bad times, the money goes back to the core. And what we currently have at the moment in Europe is 3 types of adjustment. None of these 3 types of adjustment are going down well with those people involved. The first adjustment is the recession on the periphery, and in our view, this will get worse, not better. Europe will be in recession this year. There's a good chance it could be in recession next year if current policies continue. The second adjustment is that in Germany, inflation is picking up. That is a necessary thing, but the Germans don't quite like it. Hence, they're putting pressure, as we saw yesterday, on the European Central Bank to come out with tough comments about fighting inflation. And the third type of adjustment is called Target 2. It's through the European system of central banks. This is not a problem if you think the euro survives, but it becomes a concern if you think any one country could leave. Because currently the Bundesbank has 550 billion euros of exposure to the central banks on the periphery. So all of these adjustments are problematic. How will it play out? Well, basically, if the current system does not change, then there will be problems. But I think the system will have to change. I think the core of Europe will have to start providing finance and lending to the periphery. I think there will have to be direct buying of the bond markets of the debt. And in a nutshell, I think if it doesn't change, then Greece will certainly leave the euro, and I think then there will be a high probability of Spain, Portugal, Ireland and Italy having to leave. I don't think it will come to that, but I think if the system doesn't change, the problems will mount. What does it mean for Asia? Very briefly, there's a direct exposure which has already been seen of exports from Asia to Europe slowing. Remember that China and India export more to Europe than to America. The second impact is an indirect one on confidence. And the third impact is the one we'll probably talk about today, which is via the banking sector here in Asia.
Thank you, Gerard, and thank you for your honesty. About the recession will probably linger on. You mentioned about the ECB and how we did avert a major disaster earlier in the year, but it doesn't mean that we're completely cleared, and that I think is definitely true. And because of that, I think we'll continue to see a deleveraging process, especially by the European banks. I'm going to ask Ritesh, about the S&P views. We believe the deleveraging in Europe started in the third quarter. It accelerated in the fourth quarter of last year, and we're seeing it continue on in the first quarter of 2012. What does S&P see as the main risks of accelerated deleveraging, by the European banks, and how exposed are the Asia-Pacific banks, to further deleveraging of the Europeans?
As you've heard from Gerard, deleveraging is one of the key risks that he highlights, and it's mainly because the European banks have had a good proportion of financing that has been provided by offshore banks in Asia. And as we see them facing domestic economic pressures as well as regulatory pressures, they will be cutting down their exposure here. The risk comes in more, if you look at it from the asset classes, comes in a few sectors where it's more significant, as the European banks have been far more active in those offshore markets in these systems, which are otherwise domestically self-sufficient. The sectors that I'd like to highlight here are trade finance, specialized finance lines like shipping, aircraft leasing, or infrastructure financing. Now, and this has an implication on the impact in Asia, because while we can imagine that over a period of time, though it's significant, but Asian banks can probably fill in the funding gap. But there is also another aspect, which is skill set, which is something European banks have gathered over a few years, and it is not easily transferable. Of course, Asian banks can learn. It will take time. And that's where my point is that the impact, if there is a deleveraging which is immediate and deep, it's going to be very significant impact. It will be felt through the financial markets. It will be felt more to the offshore funded banks. And I would say the ones more exposed to that are Australian banks, Korean banks to some extent because of their trade finance linkages. But over a period of time, if it was slow, and thankfully we came back from the brink because of the LTRO, so we are not facing an existential issue facing these banks, and hence they can continue to lend. So I would characterize the whole loss as manageable, given that the deleveraging process is a gradual one, barring no catastrophes on the euro front or on any of the economic front there in Europe.
Thank you, Ritesh. In Doug's keynote speech, he mentioned about the IMF estimating that over the next 2 years, the EU-based bank would have to shed their assets by $2.6 trillion. That's a sizable amount of deleveraging that needs to go through. And typically, when a competitor leaves a market, it becomes an opportunity for those those remain in the market. We need to take a look at, is that really truly so in this case, obviously. And in this instance, I would say that there's a good and a bad, there's a positive and a negative. There definitely will be opportunities, as Ritesh has mentioned, but at the same time, there will be a fair share of challenges that the banks and also just the market in Asia would definitely need to shoulder as we go through things. What I would like the panel to do is, maybe cover and touch on both the opportunities and also the challenges that we may see. But I would like to start with the positives. I would like to start with the opportunities. And the next question I would like to pose on Gilles, I would like to ask you, that ANZ has always viewed Asia as an opportunity, and perhaps there's even a new or renewed aggressive Asia-Pacific strategy at this point. As Asia's CEO, and you're at the helm of this strategy, and would like to ask you, what opportunities are you seeing now? And especially, under the aggressive Asia-Pacific strategy that you're pushing ahead with.
Thank you, and I'm glad that you put me in the opportunity camp because I've got the luxury of one, not being based in London, and two, not working for a rating agency. So I tend to see the world in a more positive fashion. But frankly, I think the European bank retreating from Asia is actually a massive opportunity for Asian banks like ours. You mentioned the trade finance. I mean, there's always been the bread and butter of Asian bank, and it's something that Asian banks are doing well. And I believe that we are very well equipped to continue to do that in a much more assertive fashion, if anything. I mean, if you look at the system, well capitalized in aggregate, very liquid, and actually well regulated. And if you look at a balance sheet of a typical Asian bank, you can see that we can absorb quite a lot of capacity in that short-term term of financing. Yeah, I would agree that on the long-term financing, project finance, structured finance, it's slightly more problematic, but it's still an opportunity. And I slightly disagree that Asian banks don't have the skill of this because skill can walk, and it's actually a massive opportunity for Asian bank to go in the market and to actually buy the necessary skill if they don't have it, but actually by and large they do have it. So I see tremendous opportunity. It's much better to actually operate in an environment where economies are growing at a rapid pace. It's much more conducive to work and bank clients across Asia, supported by government initiative, as we've seen over the past 5 years, where the regulatory system is, while conservative, but well suited for the opportunity. So, we see tremendous growth ahead, and timing is everything. And I think we are well prepared to actually, as Asian bank, to take the slack that anyone want to leave.
Well, thank you, Gilles. I'm glad that you were glad that I asked you an opportunity question, but rest assured, I'll ask you, the challenges that you're also facing as well later on. So I think we heard from him that, well, at least from an Australian bank, that they feel that there's an opportunity lying ahead, and I think facts and figures are also showing that the Australian banks have actually replaced some of the financing that the Europeans have left behind. I think also the stats are showing that the Japanese banks have started to expand their lending base over the course of the last few months in Asia as well. And the Japanese, if you recall, went through their own deleveraging process about a decade ago. So it's interesting to see there's a bit of a reversal of roles at this moment. But I would like to ask Doug a question. Doug, you were a CEO of a Citigroup Japan. You were competing with the Japanese banks and also partnering with Japanese banks, so you know a lot about them. I mean, what is your view of what the Japanese banks are doing? And then also, more importantly, what do you think the Japanese banks can do in the future to really seize this opportunity and take advantage of the strong yen and also their desire to wanting to go and expand outside of their low-growth home territory?
Thank you. And let me start by with a kind of a philosophical statement that one of the lessons learned in the crisis over the last few years is that everybody that had a prior crisis came out of this one very well. The Canadians, the Australians, the Japanese, others have had much less of an impact from the U.S. subprime crisis and the current European crisis because they had already put their houses in order. It's interesting to remember that there used to be an Asia crisis, and there were lessons learned from that. Banks were recapitalized, they had strong liquidity. And as we came into the crisis in 2007 and 2008, the Japanese banks had been going through their own period where they had been recapitalized and had very safe, very simple businesses, and have come out of the crisis now with very strong capital, very strong liquidity, very clean balance sheets, and it's an opportunity for them in that kind of a stable market to start looking at opportunities for growth and expansion. We've recently seen SMBC purchase major assets from RBS. They purchased a large portfolio of aircraft assets and aircraft leasing. This is the type of opportunity that I'd expect that not just Japanese banks, but other banks will step into to fill the needs, either because of the deleveraging directly or indirectly, what would be the banks looking at core and non-core businesses and splitting themselves up into different types of businesses and having the ability for Japanese or Australian or other banks to step in and pick up and buy these pieces. I would, final comment based on your question, though, I had at Citigroup been involved in many, many acquisitions over my career, especially the last 6 or 7 years. And I've also watched a lot of acquisitions. And it's something that banks should be very careful about. Acquisitions are difficult. They're not always successful. In fact, half of them are not successful. Sometimes they're not successful because the original intention or original asset or business model that's being pursued is not a good one. Some of them are not successful because people pay too much. They get excited by the hunt of the deal and come up with emotional or ego reasons to complete an acquisition that have nothing to do with a fundamental business model. But very importantly, and a very important lesson for Asian banks and Japanese banks, is that a lot of acquisitions never go right because of social issues and the soft issues on integration and leadership and business model and making decisions that are very important about how companies are going to work together. So I would conclude by saying that I do think that there's a great opportunity for Japanese and Asian banks to build out their business models, to expand. But I would do so very, very carefully, ensure that the strategic underpinnings of that are well-founded and that the execution capabilities are followed through on.
Thank you. Doug, you mentioned about acquisition, since Gilles, you didn't talk about acquisitions per se. Can I just maybe push it back to you to see if there's something about acquisition you want to talk about? Obviously, if there's something going on in ANZ, that's something that is going to be very confidential, so we won't be able to learn that from you. But just in general, would that be an opportunity for an Australian bank as like yours?
Well, I think I'm absolutely, and we are squarely in the same game that Douglas can mention that acquisition is part of corporate life, but I think the important thing that we have demonstrated over the years is being very disciplined about being on strategy, being value somehow accretive in the medium term, and the most important thing, and that's the integration issue. Can we integrate this? But, frankly, we see so many organic opportunity at the moment in Asia that this is really the core of our focus at the moment. So sorry, I'm not going to give you a market-moving news.
I've been going around, around Asia, talking to various banks. The feedback that I do get is, acquisition is an opportunity, but sometimes they get surprised with sort of like the pricing that it's been offered. So. While people would think, given the situation, there must be bargain out there, the banks that I've talked to have basically said that, there's really no bargain out there at this moment, and things could change, but that seems to be how things are going. I would like to talk about maybe the Chinese banks, we look to China now when there's a problem. Maybe many of the sovereigns look to China to hope to see if the Chinese could actually buy their debt. Would the Chinese banks also be a help in this case? Is there a bigger role that they can take in Asia Pacific? And if so, what can they do? Henny has been doing an extensive research in China, and I would like to pose this question to Henny.
Thank you. Doug mentioned the RBS aviation leasing assets, which were sold to Sumitomo Mitsui for $7.2 billion. China Development Bank actually offered $240 million more. And RBS didn't sell to the Chinese because they had doubts about whether the deal would actually be approved in China. And obviously they were terrified because their job is to maximize returns for the taxpayers of the UK. So I was in China a few weeks ago and I met with China Development Bank and I said, so would you have gotten approval for that deal? Or was RBS right? And CDB top senior executive said, we absolutely wouldn't have gotten approval. So I love this story because it says that China still isn't ready for the big leagues yet. And I can go through a lot of other stories. I mean, Bank of China showed up twice when Temasek was trying to sell its stake in BII in Indonesia. So in some ways, they're still not up to world standards. But on the other hand, a bank like China Development Bank has a huge advantage. And the thing that I concentrate on when I look at the world is the cost of capital. And to me, one of the lasting impacts of this crisis is the fact that despite all the liquidity in the world today, the cost of capital is still going up. And banks like CDB, which uses the balance sheet of China as well as its own balance sheet, has a huge competitive advantage. I spend a lot more time these days talking to quasi-government financial institutions. I think it's as important to talk to JBIC today as it is to Sumitomo Mitsui. And you will see cost of capital as a huge competitive advantage. And I think that CDB in particular is an example of a bank that will use that and have an increasing presence, particularly in Asia, particularly in countries like in India or Indonesia, which are looking at much higher cost of capital. Thank you.
Well, continuing on with sort of like the opportunity streak, I would like to ask Lito, what opportunities exist for a bank like yourself? As a European bank, but definitely does not share some of the issues that other European banks are sharing. It actually may be a major opportunity, for Credit Suisse. Lito, just in general, what's an opportunity for your bank, and also what opportunity do you see generally for Asian banks?
Thank you, Chung. I think to answer that question, maybe I could just add some comments to some of the earlier responses that we've received. When I look at the opportunities that is being created by the gap, because of the deleveraging and the withdrawal of many of the European financial institutions, I have to say that over and above that, one also has to consider that the financing requirements of Asia continue to grow even without that, because the economies are growing, trade finance is growing, still a lot of infrastructure to be built. Even the ADB alone, estimates some $7.7 trillion US dollars over the next 10 years is the requirement of Asia in terms of building up its infrastructure. So even if you were to disregard the gap being created by European banks withdrawing, there's already growing financing requirements in Asia. For institutions like Credit Suisse, and we're a little bit different than many of the traditional banks that come out of Europe, because we don't have the traditional commercial banking arm that's very active in trade finance, in project finance, and so on and so forth. What this gap is creating are opportunities for alternative types of financing. While the capital markets in Asia are not as well developed, or they're developed but in different stages of development depending on the economies and depending on the markets, what we find is that some of the gaps that are happening because of the withdrawal of the European banks can be filled up by capital market solutions. I'll give you a very easy example. Just very recently, maybe a month or so or two ago, right here in the Philippines, we led a bond issue for a mining company, unsecured, unrated, which in the old days, or not to recent days, might have been done through a bank syndication, where you will have some local banks, some European banks, maybe some Asian banks participating. That would have been difficult to do in this environment. So we did a bond issue that was subscribed to by some Philippine banks, but some institutional investors, some private banking investors, and so on. And I think that's where we find the opportunities. It's helping develop those alternative sources of capital that, otherwise there was no incentive to do so, because in the past, with abundant bank syndication markets, bank financing could easily have been done at cheaper rates, more simply by bank syndications. Today, that's not so, that's not so available. Trade finance, for example, I think to me is also an area where, while yes, local banks are able to fill a lot of the gaps, but local banks, and there's a lot of liquidity in different markets in Asia. Liquidity, though, in my observation, are mostly in local currency, not always in the dollar or non-local currency liquidity. Philippines is unique because we have a very mature foreign currency deposit unit where we've always had a dollar market in the Philippines. That's not the case in many other Asian countries. So some banks may be liquid with local currency and can certainly support all of those local currency requirements, but not necessarily so if some of their clients would now say, well, I have a large shipment, I need dollar financing, or I want to make an acquisition outside of this country in another part of Asia or indeed in Europe or in the US, I need dollar financing. Some of those financings are not available. And so we need to be a little more creative. Look at credit enhancements. We're trying to work with some of the multilateral and bilateral agencies as to how we can credit enhance transactions so that they can become, they can be financed. Again, either through the bank market, but very often through the capital markets.
Thank you. And I certainly agree that Asia Pacific has huge growth needs, and regardless of the European situation or the deleveraging, there is huge needs to cover for the financing, and definitely I think capital markets is the solution, or is at least one of the solutions, and we certainly need to take a look at that. I would like to come back to capital markets again. A bond market. That's is something that could fill the gap, and we do need to nurture. And it's something that S&P obviously is something that's close to our heart, and we would like to make sure that we help develop the market. And I would like to come back to that later. But at S&P, when we talk about the European operations or the Asia Pacific operations of European banks, we categorize into three groups. There's the one that regard Asia Pacific as core, another that looks at it strategically important, and another that would have less presence. But when we talk about Standard Chartered, that definitely falls under the first category, with the wide Asia Pacific network and also stable, robust deposit base. I think Standard Chartered would regard Asia Pacific as a core market. And for a bank like that, Gerard, what are the opportunities and what are you seeing?
Yeah, well, the Standard Chartered would have released our interim statement, I think, this week. But basically, we've had a very strong first quarter. And indeed, we've had 9 years of record profits. The last decade has been a very good one for the bank. And we have been very focused on Asia, Africa, the Middle East. And I think we, like a number of other institutions around this region, are very well capitalized, very liquid. And the key to the success is to be very focused on the clients and helping the clients in their strategy. I think the external environment is really changing. And it's interesting to note that the discussion we're having here about Asia is similar to discussions being held in other regions of the world. For instance, I was at the FALABAN conference, Federation of Latin American Bankers conference last November, and the big issue there was how will that region cope with European banks withdrawing? And what was interesting there was the conclusion that everyone seemed to come to was that Latin America would do well because Chinese banks would step in, American banks would step in, and very importantly, the local banks would become more regional in their outlook. I think that's also happening here in Asia. Like Henny was talking about China Development Bank. That China Development Bank is very interesting. For instance, at the beginning of the crisis 4 years ago, Chen Yuan, who runs it, was very open. He said that their focus was changing. It was to help develop China's financial sector to become very international. And the Chinese have a big source of funds. And I tend to say the three words that characterized the last decade were made in China, and the three words that will characterize this decade will be bought by China. And I think it will be interesting to observe how the Chinese do start to become more outward in their approach, although for the moment, naturally, they're very much focused on their domestic economic agenda. But in terms of Standard Chartered, of course, Asia has a bigger challenge than Latin America because European banks have a much bigger exposure to this region. And as Doug was touching on in his speech earlier, the deleveraging process in Europe is going to be onward going for the next 3 years. So what we've seen in the last 3 to 6 months here in this region is likely to continue. Now, of course, the European banks are withdrawing from many other regions. The Bank for International Settlements 2 weeks ago came out with data showing that cross-border flows fell $797 billion in the fourth quarter of last year. But the withdrawal from Asia was relatively small, $77 billion. And interestingly enough, European banks withdrew from China, first net withdrawal of international lending to China in 10 quarters. But this process is going to continue. Europe, excluding the UK, accounts, I think, for 16% of Asia's gross external liabilities. So it's important, but what the other regions do and what the local banks will do will be key as to how this region plays out. What we are seeing is that, and we've seen this at Standard Chartered, the syndicated loan market, for instance, has changed already considerably in the last 4 years. Chinese, Taiwanese, Japanese banks dominate that market. Standard Chartered has good relationships with clients. We can provide longer-term funding. So we've stepped in there where European banks have withdrawn. Trade finance is an area I think we need to be particularly focused on because in the wake of the financial crisis 4 years ago, trade finance was hit hard, particularly in this region. And that's why the innocent, in terms of countries that had not engaged in financial shenanigans, were hit harder than the guilty in the West. And we saw recessions across this region. European banks play a very big role in the trade finance market. And we're seeing some evidence that some of those European banks have started to pull out of that at the end of last year. Maybe the biggest challenge for this region has already been touched on, and that's the role in terms of longer-term financing, project financing, infrastructure financing. As has been mentioned, there's a huge need of about $8 trillion over the next decade for this region. So we shouldn't underestimate that impact. But in a nutshell, I think what's happening is that the gap is going to be filled by others, local banks, Asian-focused banks like ANZ, HSBC, Standard Chartered, and of course, you're going to see some other players, maybe the Americans, come back in as well. On top of that, as has been mentioned, Asia does need to deepen and broaden its capital markets. But quite frankly, this region is really far too slow in opening its markets. The politicians and the policymakers talk a good story, but they're not really acting quickly enough. And 3 years ago in Indonesia at the ADB meeting then, it was highlighted for Asia to move from export-led to domestically driven growth needed social safety nets, needed help to SMEs, and it needed deeper and broader bond markets. We are now seeing the bond markets grow, but as I say, it's not big enough. Last year, corporate bond market across this region grew by 17%, but from a very low base. Philippine corporate bond market did pick up about 13%, but we need to see greater speed of movement. So in a nutshell, what we're seeing successfully at Standard Chartered is we're stepping into other areas. We're actually servicing our expanding client base, and also we're heavily involved in the growth of the local bond markets in this region. But while all those are positives, given Asia's growth potential, there needs to be even more rapid development of those bond markets, and deeper and broader bond markets, I think, is a necessity, and that's probably going to be one of the most attractive areas to focus on in coming years.
Certainly enough financial resources in Asia available even today. What we don't have is really the infrastructure to transfer those financial resources to where the financial resources are needed, and it's because of the lack of development in some of the local bond markets, the lack of a regional bond market, the very fragmented equity markets around the region. And I think I share, and I've been in, as you know, you've mentioned, I've been in government and I've been in some of those policy discussions. And I recall, the conversations 10 years ago when I was finance secretary, around the ASEAN, around APEC about, promoting integration of financial markets. And to today, they're still in blueprint. Yeah. I mean, many of them are still things to do, work in progress, notwithstanding the fact that 10 years have passed and we've gone through 2 crises, since. I think we really need, and I think especially to this audience, because in the ADB meetings you have a mix of policymakers, regulators, financial players, and so on and so forth. And I think it's important to keep on hammering that point that we need to move much faster on creating, the mechanisms that will allow us to channel resources that are already available, yes. Right? Except they're available in the wrong forms. Banking is still bank finance is still the main source of financing in Asia. The capital markets are still, much less developed. A lot of local politics, a lot of intramurals. One country competing to be the financial center, the regional financial center versus another. Preventing much greater integration. And I think we just need, in gatherings like this, we need to keep on hammering that point.
Yeah, and maybe just to add, building the institutional investor base across this region. Asia has phenomenal high domestic savings, but that's not necessarily accumulated in the right area. And we need to get those high domestic savings to fund the domestic infrastructure needs. When the ADB issued thematic bonds in the last couple of years, they met with strong demand. So we need to actually see many different aspects, as you touch on, in terms of the whole infrastructure behind these markets.
Well, S&P can play a role.
Absolutely.
Yes.
Absolutely.
On the credit ratings and education.
Yes.
Education of investors, the investor market. Allowing for or promoting inter-regional, transfer of financial information, harmonizing practices. These are things that an institution like S&P can comment on and push for.
How much of it do you think is self-interested on the part of the government? I mean, if you look at the Japanese banks, their portfolio of JGBs is larger than their domestic corporate loan portfolios. Governments have agendas, and they're so focused on how do I finance my debt, and I don't want things that are going to be attractive. I mean, I can remember, people at the CBRC saying to me, well, if we have a corporate bond market and they offer higher yields than our Chinese government bond market, everyone will buy their debt and not our debt.
Henny, I think you strike the point in terms of what's really getting in the way of the development of regional capital markets. It's really domestic agenda not aligning itself with the regional agenda. Exactly. And I've seen this up close. I mean, and I make these comments in many other public gatherings where I say it's nice when we get together as ASEAN or APEC or East Asia Summit and we talk about regional integration and what we need to do with each other and so on and so forth. We go back to our respective homes and all of a sudden that's at the bottom of the file and we're starting, we have I doubt if any capital market development plan of any country actually has regional integration as a big part of that capital market development plan. Speaking for the Philippines, at least when I was sitting there, it wasn't. So, and very often the domestic politics in finance does not really support. Why would the local brokers of a local market support integration of the equity markets in the region, right? They will lose some of their monopolies, right? So, and I think those things get in the way.
Right. Can we hear from other panels about maybe the opening of capital markets? And Gerard, you talk about how maybe the politics and everything, and how the market should actually open up faster, and maybe they're not opening up. Although there's been a lot of discussion about that. I mean, do the panelists agree to this? Ritesh, maybe start with you. Do you agree that that there's a lot more to do in terms of opening of the capital markets?
Absolutely, without any doubt. Because if you look at the characteristics of markets in Asia, they're much more banking dependent, and contrasted with U.S. on the other end, which is much less banking dependent. So the trend, I'm not saying U.S. is ideal that way, but we need to move towards that. And part of the challenge which will be faced by Asia over the next few years of deleveraging, or maybe another challenge as well, is to get capital market to also shoulder some of this burden. If you look at, and this is something similar to what Henny said about cost of capital, intermediation does have its cost to the economy. And hence, from an economic standpoint, it makes sense for capital markets to play a bigger and bigger role. So, and there I'd like to go back to the point about boon or bane for Asian banks. Deleveraging, on the whole, is going to be a boon for the banks. But from an economic standpoint, the mitigant is capital market development, which of course means sharing with capital. For banks will have to share with capital market. So it's a mixed bag there, depends from an economic standpoint, absolutely a must. Capital market development is key, and a lot of action needs to happen on that.
Can I make a comment?
Sorry, go.
Yep. I'd like to follow up with two related comments. The first on domestic view from outside of Asia. One of the difficult situations that banking systems and politicians face right now in Europe and the U.S. is that the cost of the financial crisis was borne by governments. Banks were bailed out. There was local deposit insurance, which has now been increased, the size of local deposit insurance. And there's almost a backlash in some ways where domestic banking markets are going to be protected. They want to make sure that you see that there's a prioritization in a local market for development and for investment and for protection. And so this, I mentioned just the word of protectionism, and one of the unintended consequences of what's happening potentially in Europe in particular is that more and more focus on a domestic market and domestic protection of the local system, which means that for Asia, you are going to have to look more and more for regional opportunities, and I do think it's a very big opportunity. Now, I'm going to contrast that with something which is a completely different view, not the political view and not the view of people that were worried about the bailout, and that's the view of meeting with large global institutional investors, whether it's Boston, New York, San Francisco, Los Angeles, Pasadena, it's Tokyo, it's London, it's Brussels. When you meet with large global investors, they will tell you that the #1 demand that they have today is regional and global asset allocation, and the #1 market that they're underallocated in, that they need more assets in, is Asia. There is a huge demand from investors to have asset allocations, whether it's by different types of asset classes, it's different types of regions, it's different type of structures, et cetera. But there is a huge demand from institutional investors around the world for more and more Asian product and Asian exposure. And so there is an opportunity outside of the banking market with hedge funds, with pension funds, with insurance companies, and other institutional investors for much more interest and much more volume coming into Asia, also as one of the ways to replace the banking market, which also points then to the need for much more development of the capital markets.
Yeah, I think that last point is very, very important. We see this at Standard Chartered. 2 weeks ago, we had our biggest ever client event in New York. And it wasn't just the quantity, it was the quality of the clients. And the institutional client base in the West is not only underinvested in Asia, is underinvested in Africa, and indeed emerging markets generally. And in terms of the US audience, they tend to think in recent years more LATAM, more China, but now it's becoming a lot more diversified. The big challenge, and I think this will be reflected in economic terms in inflation for Asia next year, is that Asia doesn't have the ability to absorb these inflows. Brazil obviously saw big inflows last year, leading to worries about currency wars. Last time we saw the big inflows into Asia 2 years ago, it led to talk about the need for capital controls. Next year, we're likely to see another wall of money as interest rates in the West stay so low for so long, and that wall of money will have to come to the emerging markets, so it's a big challenge. The other problem, of course, in the West is regulators are over-regulating the financial sector. Having gone from one extreme of light, they're now going to heavy regulation without really going for right regulation. And the central banks in the West seem to, and the regulators seem to assume that capital is always available and cheaply available. And that's complete and utter rubbish. They also assume that buffers are things that you can go into. But buffers effectively are seen by the markets as being frozen. You can't go into them. So you're now having minimum levels of capital, and capital is becoming expensive. The cost of capital is high. Thankfully, Asia as a region has very well capitalized banks, very liquid banks. So all of these external environments, the regulatory burden in the West is a challenge. And of course, the low interest rates that's going to see that flow of money into Asia is an opportunity. On the positive side, in the last year in Asia, ASEAN is probably the most interesting. I've always tended to think that ASEAN always talked a good regional story and always acted nationally. But in the last year, it has started to talk regionally and act regionally. And we've now started to see central banks, or countries rather, reserve managers, buy the bonds of other countries in the region, which is not something that they were doing before. But maybe just to conclude in this section, I think the most difficult challenge, I would say, for all of us in this room is there now a risk-free asset globally? And it's not too clear to me that there is. Obviously, people have always thought the risk-free asset was US Treasuries or government debt. But when you have the US Fed with 20% of its balance sheet being 20% of GDP, the European Central Bank's balance sheet is 32% of GDP and rising. What do central banks now do with their money? What do countries now do with their money, rather, in terms of currency reserves? Asia has 2/3 of global currency reserves. And in the last 6 months, it's been quite interesting. Both the Swiss and the Israeli central banks have both publicly said that they are now going to allocate a significant but single-digit proportion of their reserves to equities. And I think you can start to see Asian countries start to use their currency reserves in a more proactive way. They don't want to necessarily just buy dollars and US Treasuries, but that money can also start to be used across this region. But the question is, what's a risk-free asset? And if people start to buy corporate paper and equities, that will be a very significant development as well.
Thank you.
Just a comment. I think the view of Asia, acting in isolation, etc., and the government of different country maybe not doing enough is probably, dare I say, a pretty Western view of what's going on here. I think there is a lot more financial integration in Asia than people realize. If we look in Europe and even in the United States, I actually think that fragmentation is actually a lot worse than it is here today. And in reality, the development of the debt market, in every form, has always been led by the private sector. And recently, we've done a deal for a financial institution in Singapore where 81%, more than 80% of the proceeds went to Asian investor. So I actually think, as the story in Asia developed, I think the private sector, through more transparent rating, more transparent and liquidity, and some policy support, I think that capital market will develop. Also, there's the emergence of those regional players. Singaporean bank, Malaysian bank, some of the Chinese banks are actually developing regionally. And so by virtue of their business model, they will actually disperse that capital and that flow of debt across the region. So I'm actually a lot more optimistic, and it's actually not that different than what we've seen in Europe in the 80s, in the 90s. But I actually think, given the dynamism of the region, given also the aging population, especially in North Asia, which have a real need for a long-term asset, we actually think that emergence of capital market will occur naturally.
I'm sorry, if I may just react. Yeah, Gilles, I hope you're right. And I don't think it's from a westernized view, though. I think the frustration with the slowness of progress with regards to opening up markets in Asia, the slowness of the regional integration that should already be happening in Asia is a very much a local. I certainly consider myself very local, and I'm very, very frustrated about it. And I've seen it in the level of government. I've seen it in the market. It's a market player. I think I want to relate this comment to what Gerard was saying, what Doug was implying. There's a lot of money that would like to flow into Asia, but there's an absorption constraint. We don't have the absorption capacity. We're not developed enough in many of our markets to be able to absorb all of this capital that's wanting to go in. One only has to look at the average daily trading volumes in many of our stock markets outside of the 2 or 3 financial centers. They're not enough to absorb big institutional investors coming from the US, coming from Europe, who want to invest in Asia. we cannot be satisfied with the rate, with the progress that we're making. I mean, ANZ is a wonderful example of being a supra-regional, very successful one. And by the way, Credit Suisse is very happy to have supported some of those inorganic, activities that you've had. And I was hoping you would mention it, but then I will mention it, as we have advised ANZ on some of those acquisitions. But I think we cannot be satisfied. I think when you look at the enormous requirements of Asia, and not just driven by the withdrawal of the European banks, but just by our intrinsic demand for financing, we need to move our markets much faster. We need to open up markets like China and India much faster. I mean, why should Chinese banks and Indian banks aspire to be regional or global institutions when they have still so much to do in their domestic markets, whether it's in IT, in risk management, just in branch penetration. I've seen numbers of ATMs for 100,000 people, number of branches per 100,000 people in China and India, and they're so way behind even a middle-income economy in Europe.
Yeah.
So there's so much to do.
I have a question related to that, and we should probably leave some time for the Q&A. So I would like to maybe make this a last question, but you talked about opening of the market. Definitely need to do that. We have to do it faster. And that typically means liberalization, and it means deregulation. But on a global level, I think there's a lot more regulation that's been imposed. So how do we align that regulation versus deregulation? Whereas I think in the local market in Asia Pacific, I think we need to deregulate, but there is a global movement to regulate.
Can I just say one thing on that? And I'd like to pick up on Doug's point. And he's concerned about financial protectionism. I share that concern, and I agree with you that ASEAN has talked, regionally, acted individually. I see that continuing today. I look at sort of the war between Indonesia and Malaysia on bank licenses, and I think this is ridiculous, especially, Indonesia, needs capital, and it will increasingly need capital as its current account will worsen, and the cost of capital is quite high in Indonesia. And yet, the finance minister used to run Bank Mandiri in Malaysia, and I see this danger of the interests of regulation and prudential regulation actually turning into financial protectionism, and I think Doug is right to focus on it.
Yeah, I think the politicians and policymakers and regulators need to recognize what we've touched on, that for Asia to realize its economic potential, it needs domestically driven growth. It needs deeper and broader capital markets to help that. It needs infrastructure, therefore it needs to be raising finance for infrastructure. And also the other key area that we've only sort of vaguely touched on is one of the biggest economic developments is what might be called South-South trade. We've called it new trade corridors for the last 6 or 7 years at Standard Chartered, and it's been the big area of growth for us. That's as more and more players within this region trade with one another. Intra-Asian trade has risen substantially. Asian, African, Asian, Middle Eastern, Asian, Latin American trade. Commodities are part of it, but commodities are only just one part. And I think the role for not only Asia-focused international banks, but also the local and regional banks to finance that trade is also an important aspect of the story as well in the future.
Well, thank you. I would like to thank the panelists for a robust discussion, and I wish I can actually stay here for 2 more hours and listening, to the discussion that's going on. But at this time, I think I do want to actually, give the audience a chance to ask some questions. Maybe the priority goes to those who actually, and haven't had a chance to have, lunch. But there's a gentleman in front who has a question.
The first question, I want to maintain the tradition of your seminar to raise the first question. My name is S.C. Jha, former Chief Economist of ADB, and also I could say former member of the Indian Prime Minister's Economic Advisory Council. I have been the practitioner for Asia for 40 years, observing what has happened in Asia, and what I feel that Asia has gone a long way, and this is the high time for the world to see what best can be done to further generate the momentum of economic growth. And here I think one of the areas that Asia and the support that for Asia needs is the question of all through long years, it was export-led growth. but the impact is direct from the European crisis. Right in the last few years, and India is one of the pioneers in that we gave the focus on the domestic demand-led growth. And in the 2008 crisis, if India could show a better performance on growth, it was basically the domestic demand and domestic consumption. And here now the whole format of the financial package and so on, that needs to be looked into very, very critically. Now, the question was whether challenge and opportunity. I would say at this point of a time, Asia is facing a big challenge, not opportunity that much as a big challenge. And in that challenge, Asia was almost ready, had started doing a lot of things on the opening of the financial sector, the capital market and so on. But Asia got stuck right now last 2 years. So in order to have the process of reform in the financial sector, how capital market can be further widened and deepened and so on, this is a big challenge, and this is where all support is needed for Asia. Thank you.
Thank you.
I'd like to comment on something I alluded to earlier, and we've mentioned here a little bit, and it follows into the question about capital markets. There is if we all sat here and said that there is an opportunity or risk that's looming in front of us that we should be dealing with it's the demographics. And it's the aging population, which the reason I bring it up is that it's a very different situation, whether you're in North Asia and Japan or you're in this part of Asia with a younger population. But one of the lessons learned is that even if you have a young population and a growing population, it's time to invest now in pensions and healthcare. You can't wait until it becomes too late. You can't wait until you don't have the ability to fund that. The reason I mention it in following up on your comment about capital markets is that the benefit of investing early in pension systems and social protection systems in young populations is that it also provides you a source of capital for capital markets. And it is capital which is employed in long-term investment. It's employed in infrastructure investment. And I would think that part of this dialogue about capital markets, about investment, should also include some discussion about social protection and today advancing the charge of pension funds and long-term investments in healthcare systems. And the benefits are much beyond just the social protection that come with them. They also help the markets.
That's great. I'd like to offer one perspective on this, Yutsung. In terms of development of capital market, we talked of regulation a while, and it's on that. I often notice when I speak to regulators in Asia that there is a strong sense of vindication felt that the free market doesn't work. Our prescriptive ways are the way to go. But I can't kind of miss seeing that this is probably the pendulum is swinging to the extreme in Asia, and that while it is right that prescriptive regulation does have a sense, but taking securitization as really a dirty word, and that has an implication on the kind of product shelf that is available for investors, it's available for pension funds, is a huge issue. Having alternative products like covered bonds, you need to have a suite of products to be made available, which is of course part of the reform agenda, but the regulators will need to see it in a balanced light, not just simply thinking of financial stability within their domestic microcosm. It's a much wider perspective that they need to take.
I was just going to say, bring it back to Europe, if you want to become really, really, really worried about Europe, look at the pension issue. When Bismarck introduced the pension age in Germany, it was set at 70 and life expectancy was 59. When America introduced the pension age at 65, life expectancy was 62. This weekend, Mr. Hollande is likely to be elected President of France, and he said he's going to reduce the pension age, reduce it to 60. Europe is fundamentally broke, and the politicians can't recognize it. So Asia clearly needs to be sorting out its own problems, and as Doug said, the sooner you address them, the better.
Hi, Lito. I come from the private sector, and this is just an observation based on the discussions that and the points that you've raised about the absorptive capacity of Asia. I think your observations are correct, but on the other hand, being on the private sector side now, I think there is also a need to review the cost structures of the banks, because sometimes they're, a little on the high side when you talk about the ability of Asian companies to actually pay the cost of the bank services. And second, is the lack of research investment in this part of the world. For instance, I come from a company, it's one of the largest conglomerates in the Philippines, but there are very few analysts that actually cover our company. So I think that reduces the ability of certain banks or investment banks to educate the investment community about the fundamentals of our company. And third is the credit rating metrics. I'm not sure if the current credit rating companies have certain metrics that are actually fit, to measure the fundamentals of Asian companies. So I think those are certain observations that I have. Thank you.
Okay. Maybe on the third one, Ritesh, do you want to take that question about the metrics?
Yeah, the short answer is yes, they do fit. And I would suggest that let's not judge fitment by the kind of ratings you get, but the way it's explained. And to the extent it's grounded in sound rationale, and to the extent we see logical rating movements happening from a lower risk to higher risk or higher risk to lower risk, both ways, I would say, and I would claim, Yutsung, there, is that our methodologies are perfectly capable of capturing all parts of Asian economies and all local nuances as well.
And I would just add that we'll continue to look at the local nuances and local practices and try to incorporate that into criteria. But we believe that global comparison and comparability is very important, and we'll continue to look at it from that light. There's one thing from that question that I do want to touch on, which we didn't have the time. It's about product and innovation, and I think she talked about certain things that are there products out there that actually we need to provide more, and maybe Lito as and I'm going to give you this because thank you for coming 2 years in a row. I'm going to give you the last question. Are there products that we're missing? Are there innovation that we need to do? What are there out there?
There's just a whole myriad of products and services that I think can still be developed and applied in Asia Pacific. I don't think one needs to enumerate because there will be too many. But I think, partly in response to the question of Cora Guidote, by the way, who used to run the Investor Relations Office of the Philippines, of the Philippine government. I think it speaks of the lack of local financial infrastructure, not physical infrastructure, but financial infrastructure. There are not enough financial intermediaries, with the scope, whether it's research or other things, to be able to absorb all the funds coming from domestic sources as well as offshore sources. And I think that's what, both market players like Credit Suisse, ANZ and Standard Chartered should be working on with policymakers and regulators to create that environment so that we're all incentivized to build those so that we can provide the most cost-effective services to our clients. But on fees and cost, let me just say that I think Asian clients, I include myself because I used to be one of the issuers, when I was in a different capacity, but we're really spoiled when it comes to bank fees because, you compare bank fees in Asia to what is normally charged in US transactions and European transactions. We're doing pretty well, whether it's IPO fees or bond fees and so on, right? So I think it has to be, we need to create that business environment where financial institutions can do well and thrive in support of their clients, in support of investor clients, issuer clients. And I think when you have a very well-developed capital markets, the efficiencies will drive the cost down, and it will all come back to the clients.
Maybe just 10 seconds. I completely agree with everything just said, but very importantly, the idea that the financial sector can influence the debate is a key one. Standard Chartered, along with a number of other big players, have helped change or influence the the capital requirements in the BIS in terms of trade finance, which were at one stage going to be very prohibitive. And we work very closely with the regulators. I think the financial sector mustn't just complain, but I think we can help the regulators innovate. But at the same time, the innovation, the products need to be there to help clients. One of the lessons when the crisis broke in Europe was how much of financial activity was just between one financial player and another without much economic benefit. So I think we do in the industry have the ability to work with the regulators, and I think the ADB itself does a very good job.
Well, thank you. One concluding remark from me. I think the gentleman who asked the first question said that there's probably more challenge than opportunity. Even if that's true, once we overcome these challenges, I really do see that opportunities in the future, and therefore, I think we should collectively work to that opportunity. And I look forward, as S&P and personally, to be able to work with all of you to, achieve that opportunity. In any case, thank you for coming. Thank you for listening, and we'll see you next year. Thank you to the panelists. Thank you very much.